So in the second part of Lecture 7, we look at how firms organize so that the investment they undertake truly have a positive NPV. And as responsible managers, your duty indeed is to have and undertake projects that derive value for the shareholders. So let's look at how they actually do that. So before you undertake investment, it's customary in corporations to have an investment policy, a procedure, a way of working before you arrive at those investments. And oftentimes those investments are reflected in what we call the capital budget, right? Or some company call them, investments. Yes, some company call them investments, some company call them capital budgets. And key elements of these capital budgets are: one, they should reflect what is the company's corporate plan. So long term, whatever is included in the capital budget should reflect the company's strategic thrust, which could be one, going into a particular geographical location, going down a particular technology path, or targeting a particular segment of the market. But whatever that investment entails, it should reflect the company's strategic plan. Of course, there are things such as spontaneous entrepreneurship, which speaks to companies capitalizing on emerging opportunities. And those emerging opportunities might not always be included in the strategic plan. But if you're careful with the strategic plan, you will make reference to things that appear spontaneously and which the company is flexible or agile enough to really capitalize on. Before you undertake an investment, another key aspect should be that you should be able to identify what is your company's competitive advantage. So you shouldn't undertake investments, or ideally, it is recommended that you should not undertake investments that do not give the company a competitive advantage. Because what will happen is the profits that you earn early will dwindle away very, very soon. Thirdly, identify business to be sold or allowed to run down. So in large companies in their portfolio, they will have businesses that may stop performing because of one, competition, because two, their technology might have gotten old. They might have lost key staff. They might have lost an important supplier or an important customer. So those businesses ideally should be divested. Or if there is a business in the portfolio that serves an important function. So for instance, if you have a business in the supply chain that is supplying raw material for further processing or so forth, you might not want to divest that company. But surely what you can do is to let that company run down to a level where at least it's break even ideally. If it becomes loss making, then if you can compensate for that loss making by some way of increasing prices or deriving efficiencies in other companies in the portfolio, then you should ideally get rid of it at that point. The investment process should not be one way, so it should reflect both, one, the vision that comes from above in the company. So from that C-suite, it should reflect, that overarching view. And then secondly, to have really, or to undertake projects that really drive positive NPVs, you should also take the views of those who are lower down in the organization. So those who actually do the work. They can tell you things such as how you arrange a production line, how you arrange the flow of work, and they can give you real feedback how you can improve technology. So when you undertake investment, it's not just those in the higher echelons of the corporation making those decisions, but you should incorporate the views of those middle managers and those even on the ground who are doing the operational aspects of the work. The authorization of investments or projects uh, will follow paths that are specific to some companies, but here are some of the couple. So here are a couple of things that needs to be taken into account. So one, planning should be done in the ensuing year, right? So ideally, if you want a nice smooth flow of business, you want to undertake a project in 2022, then you ensure you start planning in 2021, so then it's included in 2022 budget. So it becomes a lot smoother and easier to run. You have a little more time to run analysis and justify why the investments are needed, right? Those investments should be supported by detailed analysis, and those detailed analysis can include things as cash flow forecasts and present value calculations, right? So once you want to take those investments, and those investments has been approved by uh, in some corporations in Guyana, a lot of companies have financial subcommittees, so you will submit those investments to that financial subcommittee and sometimes the risk committee, and they will interrogate the analysis that you would have done. Some do it in a very formal process, so they will have the managers who are making those proposals sit before them. Uh, they will go through the analysis, ask for justifications before they actually approve those projects. But once those projects are approved, that's not the end at all. Any responsible manager will then carry out what we call post audits. And post audits are periodic assessments that managers take after projects would have been or investments have been undertaken to see some of the problems or challenges that has arisen since implementation or approval and how you can fix them. Right? They will do a comparison of the forecast that was presented to them before the investment was undertaken. They will compare that with the actual results that are being achieved currently. And one of the reasons why they do that is to ensure or to establish the reasonableness of the forecast that was presented in the first place. So going forward, they will have an expectation or they will develop an understanding of how well managers can forecast. Related to post audits is something that we call postmortems, but postmortems are done at the end of an investment or at the end of a project. And what it does is to recap all the major lessons that would have been learned during that particular project or investments. They take those information, store those information, and the intention is to review those information, incorporate those lessons learned in future projects so that they can really derive value from whatever investments they undertake. We've been accustomed in this course to look and to calculate net present value for almost everything we do. And while we may become experts at executing that particular technique, management technique, there is always another option that might be available to us, especially in companies that have well-developed capital markets. So if you're going to undertake an investment and there's an active competitive market out there, you'll save time and you'll be better and you'll make more accurate decisions if you use those market information that is available. Right. So there's no need to carry out those extensive net present value discounted cash flow calculations once there's market value available. The underpinning assumption for that is that the market values will incorporate all the information that is necessary to ensure that the value is optimal. Right? You should remember, as we've stated earlier in the course, that it is smart investment decisions that make more money than smart financing decisions. And you'll see a little later when we look at M&M, Modigliani, and Miller. They principally said that it doesn't matter how you finance, the returns are going to be the same, right? Whether you're financed by equity or by debt, or if you finance with a mix of both, then their claim is that the returns is going to be the same. So it is important that you invest in areas, right? That you invest smartly. You invest in areas that will ensure that you have competitive advantage. It is important that you ensure that you invest in areas that the competition would not be able to quickly replicate your business model or re-engineer your business model so that what you have is a lasting advantage, right? Competitive advantage. A simple point, kind of obvious, but smart investments are worth more than the cost, so they will have a positive NPV. And then, of course, firms calculate NPVs by discounting forecasted cash flows. But you should be careful when you look at, as managers, when you're presented with projects that have net present values, because of course there will be some biases that are incorporated into those presentations. Some managers might be keen to present proposals that appear to have net present value because they might be serving their own purpose. So it's important that you really look at those information, ask the right questions, make assumptions, carry out further analysis. Right? So a couple of things you should bear in mind. Whenever we presented with the project with a positive NPV, then you look for forecasting errors. Some might be more obvious than others. So for instance, if you are going through a period or an economic period in a country where you expect slow growth or no growth, then if managers present to you proposals that shows exorbitant growth or even growth at all, then your question to them should be, why do you think we should have growth when the economic outlook looks dim? That's just one question. Then real positive NPV is, really is an offshoot of competitive advantage, because here you're saying that you have a significant advantage over your competitors, either it be cost, either it be technology, either be it closeness to a particular resource, you have some strategic alliance with a supplier. Those are things that will drive competitive advantage, and those are the things that really determine positive NPV, because then you're sure that you can charge a price that will cover all your costs. So the final point to note on market values is that strategic decision making identifies competitive advantage. It does not identify growth areas. Growth areas will come more from marketing research. So you should be careful not to make investment decision based on discounted cash flows that may have errors. Secondly, you should start with the market price of an assets and ask whether or not it's worth more to you than to others. So here we're looking at the opportunity cost aspect that we've spoken to extensively in the project, in this course, sorry. So if you look at the market price of an asset, if whatever activity you're going to undertake and the cash flows that you will derive from that, let's say it's 10, but someone else you can rent it to maybe or lease it to, they can have, and you can get rent of 12, then it is in your best interest, instead of undertaking that economic activity that will only give you a cash flow of 10, to let go of that, forego that, and lease and get 12. So when you have undertaken a project, you should not assume that that your competitors will just be relaxed and just roll over and die. They will react, and some will react aggressively. Some may not even be able to react, but that might be dependent on one, the availability of resources, finances, two, the risk attitude of their managers. Right? So those are the two main things that will decide how firms will react. And some firms are just competitive by nature. So whether or not they think that they can really challenge you, they will just challenge you just for the sake of challenging you. As managers, as we look at projects, here are a couple of questions that we can ask, or investments that are presented to us for approval. So how long would we be able to lead the market? So how long will it take for our rivals to catch up? Once that lead disappears, what will happen to prices? So would our price be able to cover our costs? Right? And what happens to costs in our case? Because of the learning curve, would we be able to reduce costs? Right? So despite competitors coming to the market, which will most likely force down the price, would us being in the market longer allow us to achieve efficiencies that will drive down costs, so it will compensate for any reduction in prices? So that's a question you can ask. In the meanwhile, how will rivals react to my move? Will they cut prices or just imitate my product? So here's an example of an investment you can undertake, or two investments that you can undertake. So in the first example, right, you can purchase a property for $1 million. Right? Or in this case, we were saying 100, sorry. And having purchased it for 100, you will, whatever economic activity you carry out, you will have net positive cash flows of 8 per year for 10 years. At the end of that 10 years, you will dispose of that property, and we assume that the property prices will rise by 3% a year. So at the end of 10 years, the accumulated value of the property would be 134. So for all of those 10 years, you have positive free cash flows from your operations of 8. And then in the final year, when you dispose of that asset, you dispose it for 134. The discount factor that you use, or the discount rate that you use, is 10%. So you have a 10% discount rate. So you work out the NPV for that situation, you get $1 million. But you will note that a significant amount of this $1 million is dependent on the cash flow that you derive from the disposal of the asset in the 10th year. And you would also agree that making a 10-year assumption could be very risky. Right? So your positive cash flow of $1 1 million is heavily sensitive to the movement in the value of the investment that you've undertaken. So if property doesn't appreciate by 3% and let's say 2%, it could be very, very impactful on your calculations and the realization of your $1 million. On the other hand, instead of undertaking that economic activity, you might be presented with an opportunity to rent the property. So you might be provided with the opportunity to rent the property. And in so renting, and you also say that rent increases by 3% a year. So you start getting rental income of, or you start paying rental income of $7,000 a year. Of course, you're still getting the positive cash flow of 8. So positive cash flow of 8 in year 1. Rent is now 7. So you get a net of 1. But the rent continues to increase by 3% every year. So that at the end of year 10, you'll only be generating a positive cash inflow of 8, and you'll be paying rent of 9.13, which is an untenable situation. But it brings you back to the same position of $1 million net cash flow at the end of 10 years. But here, it becomes a lot less riskier to get $1 million net positive cash flow at the end of 10 years because it's not dependent on, as in the first case, the sale of the property at the end of year 10. And of course, you can establish at which point the rent has surpassed your actual cash inflow. So at that point, you can make a decision to 1, either find a cheaper place, or 2, just come out of business. And at which point you will surely have a higher net NPV or a higher net equivalent NPV than the $1 million. So graphically, what it says to you is if you have an income which is a flat line of 8 per year, at the point that the rental charge goes above 8 would be the decision point that you decide to find somewhere that is cheaper, or you can just cease being out of business. So definitely at this point, you can come out way ahead and avoid the losses that you made from year 6 onwards. Another example we look at is the King Solomon's mine example. So in this example, you invest $500 million. The life of the investment is 10 years. We estimate that production will be 1 million ounces per year. Production costs is $1,150 per ounce. Current gold price is $1,500 per ounce. The discount rate is 10%. If we forecast gold price, so in the first part, we expect that gold prices will rise by 5% a year. So if we work out the NPV for that, you will have so it should be 1 million ounces for the 10 years and not 1 million ounces a year. So it's 1 million ounces for the 10 years. So you'll see in the 10 years we put in 0.1, so that should be 100,000 ounces per year. But you're required to invest 500 million Production for the 10 years is 1 million ounces, so that's 100 ounces per year. So that's 1/10 of a million, because we're working in a million here. In millions here, times the price of gold minus the cost of the gold, and you'll see that the price of the gold goes up by 5% every year. You discount that by 10%, and you should end up with a negative NPV of 35 million. So you're saying at this price and costs and investment that is required, which is being discounted at 10%, it is not feasible. You have a negative NPV of 35 million. But that will be an error, because today's gold price will incorporate all the information that is available publicly. So there's no need to discount that value. You use the market values that you have, or there's no need to escalate that value over the years. What you should use is that market value of the throughout. So in this case, the NPV would be the investments plus the PV of the revenues minus the PV of the cost, which is reflected as an investment of 500 million plus the production. So you have the production of 1 million ounces times the $1,500 an ounce. And once you work that out, you should end up with a positive NPV of 293 million. So in this example, you use market values when they are available. And the reason you use market values is because it incorporates all the information that is publicly available. So there is no need to adjust the prices. When the market values change, then you just include that market value in your new calculations. The question we ask is, do projects have positive NPVs? And that occurs when you have economic rents. Economic rents occurs when profit is more than cost of capital. Right? So NPV, net present value, is equal to what we call the present value of economic rents. Economic rents come only when we have a better product, lower cost, or some other competitive advantage. Sooner or later, competition is likely to eliminate economic rents. But there are some cases where economic rents can be lasting, especially in sectors that are safeguarded by the government or they have trade barriers. In those cases, economic rents can last a very, very long time. So economic rents and competitive advantage. So you have a proposal to manufacture specialty chemicals, raw materials or commodity chemicals imported from Europe. Right, in this example, finished product was exported to Europe. There was high early profits, but what happens when competitors enter? So in this next example, they're giving the information that the company manufactures special chemicals, that raw materials are imported from Europe. The finished product is now exported back to Europe. There are early high profits, but what happens when competitors enter? So we're presented with the initial cash flow projections. So here they invest 100 in year 0. The spread between the price and the cost is $1.20. That's what they estimate. They expect revenues to start flowing in year 2. So they will sell 40 million pounds in year 2 at $1.20, or that's a spread, sorry. So the net revenues would be 48 in year 2. In year 3 to 10, we do not expect any growth. We expect it to be constant. So they'll produce 80 million pounds of the chemicals at a spread of $1.20, then net revenues from year 3 to 10 would be 96. Right. The shared production costs. So some of the costs that they have are production costs of 30, transportation of 4, and this is per pound, right? 4 in year 2 and rises to 8 from year 3 to 10. You have other production costs of 20 throughout. So the cash flows would be in the first year of, in year 0, when there is no activity, just an investment of 100, cash flows of -6, -20 in year 1, -6 in year 2, and 38 positive cash flows from year 3 to 10. The NPV at 8% discount factor will be 63.56 million. Right, so that's the initial calculations that's presented to you. But then they realize that the European competitors could enter into the market. And what you calculate here is the break-even point, or the point at which the NPV is equal to 0, right? For European producers, because European producers will produce until the break-even point. So until the NPV is 0. Once NPV slips into a negative, then there's no point for them to continue producing the chemical or investing in producing the chemicals. So when we look at the European producer, we estimate them, they'll require the same investment, but their spread between the price and cost will be a lot less. So 2 things could be happening here. One, they can be slashing prices. So chances are they may have the same cost structure, but they can slash prices, reduce the spread. So what that does to you is to put pressure on your prices, so your prices will eventually come down. So with the spread of 0.95, right, you expect to have the same production, but we expect revenues to be 38 in year 2 and 76 onwards. Production cost to be 30 for year throughout. Transportation is introduced in year 3, so that's 80. You have other costs of 20 throughout. In this situation now, the NPV is going to be equal to 0, right? So that's a competitive European producer. That's their position. What it does to us now is we assume that the European producers will be able to catch up from year 5, right? So we will be able to enjoy. So we've revised our calculations we first presented. The spread remains, the investment remains the same, firstly. Production schedule doesn't change. It's 40 million in year 2. And from year 3 onwards, it's 80 million. But the spread that we're able to earn of 120, we'll only get that from year 1 to year 3. In year 4, it drops to 1.1, and year 5 onwards, 10, it drops to 0.95. So we recalculate our revenues. So it's our production amount times the spread that we have will give us our revenues. We have some production costs, transportation now. We have transportation costs. The other cost remains constant at 20. So now with the introduction of the entry into the market of a European company, we see that our NPV that was, when we first calculated, that was 63.5 million, has now dropped to a negative 9.8 million at a discount rate, if we're using a discount rate of 8%. Right. So this example here shows you what happens when a European or competition enters the market. So before you approve an investment, you should look at the scenario where competitors enter the market or whatever reaction that competitors will have. So that's that. We'll just work a few examples on sensitivity analysis, and that will be part 2 of lecture 7. So the first example in lecture 7, we said Empress Clothes Fashion can invest 5 million in a new plant for producing an invisible makeup. The plant has an expected life of 5 years, and expected sales are 6 million jars of makeup a year. Fixed costs are $2 million a year. Variable costs are $1 per jar. The product will be priced at $2 per jar. The plant will depreciate straight line over 5 years to a salvage value of 0. The opportunity cost of capital is 10%, and the tax rate is 40%. So A, you ask what is the project NPV under the base case assumption. So here you're given the base case, and you calculate the NPV. And then in B, you're told that variable cost turns out to be higher, so it's $1.20. So in the scenario sensitivity analysis, you'll go and change just the variable cost. Right? So you use the base case, you establish the base case, but now you're saying in B that instead of variable cost being $1 per jar, it's now $1.20. So you'll see what is the impact that will have on your NPV calculations. In C, fixed costs has turned out to be 1.5 million instead of the base case $2 million per year. And then in D, you're asked at what price per jar would the NPV equal to 0. So essentially the break-even point. Let's just work through those. Right, so question 1. So here we work out the base case scenario. So we're told that sales is 6 million jars per year. Right, so sales is 6 million jars per year. So you can set up our table to look like this. So 6 million jars per year. We require an investment of 5 million. So capital of 5 million in year zero. From year 1 to 5, units that we expect to sell is 6 million. So revenue, we expect to sell the jar at $2 each. So it's units of 6 million times $2 will give us 12 million. Direct variable costs, it's $1 per jar. So 6 million units sold a year times $1 jar, that's $6 million. So contribution is just revenue minus direct, or sometimes called variable costs. That'll be $6 million. Fixed costs is estimated to be $2 million a year. Depreciation is $1 million per year because we've invested $5 million and we expect at the end of $5 million that the investment will have a zero salvage value. So we end up at a earnings before interest and tax of $3 million. We calculate the taxes of 40% on that amount, and we'll have net profit after tax of $1.8 million. Right? We add back depreciation because depreciation is not a cash flow, but we've had to include depreciation earlier just to ensure that we get the correct earnings before interest and tax on which we calculate our taxes, right? So we include depreciation earlier just to ensure we get the right earnings before interest and tax on which we calculate our taxes. Once we've had the right tax calculation and gotten to the correct income after tax, then we just add back the $1 million depreciation because depreciation is not a cash flow. That's a book entry. And then we now arrive at what is the net cash flow position, which is 2.8 million. We apply the 10% discount factor, right? It's the cost of capital is 10%, and we will get cash flows. We get the present value of those cash flows for all the years. We add them together, we should have a net present value of 5,614,203, or somewhere just very close to that, because you recognize that in my discount factor, though it shows here that it's 2 decimal places, I've actually used the fraction as it is, or done the calculation as it is. So it's 1 divided by 1.1 in the bracket to the 3rd power in the year 3, to the 4th power in year 4, to the 5th power in year 5. So that's the base case scenario. So in the base case scenario, we have an NPV of 5.6 million, right? B says that the NPV of variable cost turns out to be $1.20. So if it turns out to be $1.20, we go back here, change the dollar to $1.20. We go $1.20 for all of them. We just change that to $1.20. And now the effect that that has is that our NPV now is down to 2.8. Still a positive NPV, but is now to 2.8 million, right? So in sensitivity analysis, we just go and we change one variable at a time, right? So let's reverse those changes. So we're back to the base case. In scenario C, it says that if fixed cost turns out to be 1.5 million, so instead of being 2 million, fixed cost has been reduced to 1.5 million. And that effect now drives up the negative NP, drives up the NPV even further from the base case, and it's now 6.7 million. Right? So the base case is just about 5.6. If variable cost goes up to 1.2 per jar, then it brings it down to 2.8. If fixed cost is actually less than you anticipated, then it drives up the NPV to 6.7. Right, so we're back to the base case, and now it's in part D. It says at what price per jar would NPV equal to 0. So the way I will do it is that I would have looked at the NPV that we have here. So it's asking at what price per jar with NPV. So everything else remains the same except the price. So the price is going to change now. So one way of doing it is to say, look, we currently have an NPV of in the base case of 5.6 million. And we expect to produce 30,000. So that's 5 years, 30,000. So I would say one way of doing it is to take the current NPV that we have, divided by 30,000. And we're essentially saying that it should be, sorry, that should be 30 million, not 30,000. So we're saying it should be $19. So if 19 cents, sorry. So if we add 19 cents to what we currently charge, or reduce, sorry, if we reduce the price by 19 cents, then this should be 0. So we go to revenue. Are we now charging at $2? One way of doing it is $2 minus 19 cents will give you $1.81. So we change it by that amount, and we'll give you a rough estimate. It's a way to start. So it's $1.81, right? $1.81. So that's one way of doing it. But you see, you still have another $10 to go, right? So you can go. So instead of taking off 19 just now, you can actually take off 38. So we can do it by approximation. Of course, in Excel you can do it. I must confess that I don't have a better way of doing it. Right? But of course, in Excel, you can play around with it a little and get it done quickly. If it was being done in a written exam, then it would have been a lot more challenging to just work out figures by using essentially a best guess to start with, and then just adjusting as you go by. So I think you can take another 19 here, which will bring you to, because when we started at 19 cents. So just now we took 19 cents off. We came around to, we were left with 10. So now we guess we can take 38 cents. So instead of $2, you can go 1.62. See how that works. And that brings you closer to 0. Right, so a little more adjustment. You're down to 428,000. So I guess you can go recheck 6 to 1. But you can change it until you get to 0. Maybe even more than that. So let me see, 59. It's still, I guess maybe it's somewhere around 68 now. So 158 would be the price. $1.58 would be the price. That will get you very, very close to an NPV of 0. Right. So you can just try figures out and you should get here. 58. Now 58 drives it into negative. So it's somewhere between 58 and 59 with some percentage points. But that's essentially how you work with sensitivity analysis. You change one variable at a time. So question 2. It says that the project generates sales of 10 million. Variable cost equals 50% of shares and fixed costs are 2 million. The firm's tax rate is 21%. What are the effects of the following changes on cash flow? Sales increased from 10 million to 11 million. Variable costs increased from 6 to million. Variable costs increased to 65% of sales. So they're asking what would be the impact on cash flows. Here we go. So you have current sales is 10 million, variable cost is 50% of sales, fixed cost is 2 million, tax rate is 21%. In scenario A, if you move from 10 to 11 million, so sales increase by $1 million, variable cost will be 50% of sales, so that's 500,000. Contribution will go up by, will be 500,000. Taxes on the contribution of 21% will be 105,000. So the increase in cash flow will be 395,000. So in scenario A, if sales move from 10 to 11 million, you'll have an increased cash flow of 395,000. So sales will increase by $1 million, variable cost will be 500,000, contribution will be 500,000, taxes on that contribution will be 105,000. So the increase in cash flow will be 95,000. In scenario B, if variable cost increases to 65%, so we'll do the base case. So the base case is when it's with 50%. So sales was 10 million, variable cost is 5 million, contribution was 5 million, taxes at 21% will be 1,050,000. So the cash flow would be 3,950,000. But if variable cost increases to 65%, then sales remain the same. Variable cost now becomes 6.5 million. The contribution drops to 3.5 million. Taxes at 1% will work out to be 735,000. And your cash flow now would reduce to 2,765,000. So the effect, the net effect on your cash flow would be a decrease of 1,185,000. So the increase in variable costs from 50% to 65% will result in a decreased cash flow of 1,185,000. So cash flow will move from 3,950,000 to 2,765,000. It still remains positive, but that's the impact that will have. So that brings us to the end of part 2 of lecture 7.